What if your investments could grow without you constantly checking the market? Imagine building a portfolio that works hard while you sleep. Hi, I'm Emma, and welcome to the Wealth Mindset channel where we break down money, mindset, and smart investing. Make sure to hit that subscribe button so you never miss a step toward financial freedom. And just a quick note, this video is for educational purposes only. Stick around. By the end of this video, you'll know how to build an investment portfolio that feels right for you. Many Americans put all their savings into a single asset class, often just a 401k or their company's stock. It may feel secure, but it's like putting all your treasure in one chest and hoping nothing happens to it. Market swings, economic shifts, and job losses can hit without warning. If your investments aren't spread out, a single storm can wipe out your progress. Chasing hot tips is like running after shiny objects in the jungle, exciting but often misleading. Without a plan, you're just reacting to noise, not building true wealth. Diversification isn't about being fancy, it's a safety net for your future. It helps you grow while protecting what you've already worked hard for. A single asset might give fast rewards, but it also brings bigger risks. Real growth comes from balance, not betting everything on one horse. The goal isn't just to survive market chaos, it's to thrive no matter what comes. Diversification is your adventure armor in the world of investing. We'll break down what diversification really means, no confusing jargon, just real talk. It's about spreading your investments to protect and grow your money smartly. I'll show you 5 essential steps to help you build a portfolio that balances growth with safety. These steps are simple, powerful, and designed for your real life. Each of these steps will include stories and real-life examples to make them easy to understand. Because learning about money should feel like a journey, not a lecture. We'll explore how to use diversification as your tool, not just as a concept. You'll learn how to apply it in your daily life without needing a finance degree. By the end of this video, you won't just know what to do, you'll be ready to take action. You'll have the clarity and confidence to grow your money wisely. So grab your notebook, your coffee, or just your curiosity and let's dive in. This journey could be the first step to building the future you've always imagined. Ask yourself, what's this money for? Is it for retirement, a future home, or your child's education? Knowing the destination is the first step toward the right journey. Think about your time horizon. Are you investing for something that's just a few years away or decades into the future? Consider your risk tolerance. Would a sudden drop in value keep you up at night, or could you ride it out calmly? Understanding your emotional limits helps shape the right portfolio. Some people can handle more ups and downs if they have time, others need stability soon. Matching your investment style to your personality and timeline is key. A 25-year-old saving for retirement has the luxury of time and can afford more risk. A 60-year-old nearing retirement needs to be more conservative to protect what they've built. So take the time to understand your financial goals, they're the compass to everything else we'll build. Without a clear direction, even the smartest strategies won't take you far. Stocks, bonds, real estate, and cash each plays a different role in your portfolio. Think of them as unique tools for building a strong financial foundation. Think of your portfolio like a sports team. Stocks are the star players scoring big points, while bonds are the reliable defense that protects your lead. Cash keeps the team flexible and ready for any unexpected plays. A balanced portfolio might look like a 60-30-10 split. That means 60% stocks, 30% bonds, and 10% cash. It's not a perfect formula for everyone, but a great example of diversification in action. Investing isn't just about picking the biggest winner, it's about planning for all conditions. If one part fails, others help keep you steady. Putting all your money into one type of asset is like putting all your supplies into one backpack on a long journey. If that bag breaks, you lose everything. When you spread your investments, one drop won't sink your whole ship. It's the key to staying on course in rough markets. Diversify across sectors like tech, healthcare, and energy, not just one area. If one sector stumbles, the others can help carry your progress forward. Use both US and international investments to balance out the ups and downs. Different economies rise and fall at different times. Spreading globally helps smooth the ride. Mix big, stable companies with small, high-growth ones to maximize opportunity. Big firms offer safety. Small ones offer exciting growth potential. Don't fall in love with just one area. Variety is your safety net. Markets shift fast, and one strong sector today may be tomorrow's weak link. During the 2008 crash, investors who diversified had losses, but they bounced back faster. Being spread out kept them in the game when others had to start over. You can't predict every turn, but you can prepare for it. Smart risk spreading keeps your journey moving even when the road gets rough. Rebalance your portfolio once a year to stay aligned with your goals. If one part grows too large, it could throw everything off balance. Major life changes like marriage, having kids, or a new job should prompt you to review your investments. As your life shifts, your financial strategy should adapt too. Set calendar reminders every 6 to 12 months to check in on your plan. A quick check-in can save you from long-term mistakes. Your investment plan isn't set in stone, it needs to evolve with you. Growth means change, and smart investors know when to shift gears. Think of your portfolio like a garden. You don't just plant it and walk away. It needs watering, pruning, and care to truly thrive. The more attention you give to your financial growth, the more confident you'll feel. Small adjustments over time can lead to powerful results. Don't panic during market dips. That's when most people sell low and lock in their losses. Staying calm lets you hold on and ride out the storm. Avoid chasing hot trends just because everyone else is. Following the crowd without a plan often leads you off track. Overchecking your investments can increase stress and lead to emotional decisions. Trust your plan instead of reacting to every small dip. Emotional investing is like trying to steer a ship in stormy waters with no map. You'll go in circles and miss your destination. One investor in 2020 stuck with their diversified plan while everyone else panicked. By 2023, they had doubled their money just by staying consistent. Staying rational when things feel chaotic is what separates great investors from the rest. Let your plan be the compass that keeps you steady. We covered how to build a diversified investment portfolio by starting with your goals, understanding your options, spreading out risk, adjusting over time, and avoiding emotional traps. Diversification isn't just a buzzword, it's your financial safety net and your springboard to real growth. A smart strategy gives you peace of mind and power over your future. If this helped you think differently about investing, hit that like button, subscribe to the Wealth Mindset channel, and share it with someone who needs this info. What part of your portfolio are you most proud of or still confused about? Drop it in the comments. Let's learn from each other. This is Emma from the Wealth Mindset channel, the power of a wealthy mindset. Remember, your money should work for you, not the other way around. Until next time, keep growing, keep learning, and keep that mindset strong.